Gentlemen, welcome to another session that we're going to briefly have a short period, a duration to check about financial analysis and specifically not all the three types of analysis, but the ratio analysis. Because, as you know, in financial reporting, we have three types of elements of ratio analysis, where we look at the common size approach analysis, where we have the trend analysis, or what you call the horizontal analysis. Then we also have the ratio analysis. So today, I am specifically going to concentrate on the ratio analysis. This is suitable for individuals doing CPA Kenya, CPA Uganda, ACCA in a financial reporting paper. So I'm sharing my screen so that we'll be moved together and we be on the same page. So checking on what we have at hand, you can see we have the notes. I've shared some copy of the notes of financial reporting. So we begin with what are ratio, and basically ratio means relationship between, in this case, financial ratios are relationship between different financial variables, and they do help to ascertain the financial conditions of the farm. We ascertain the conditions of the farm using these particular ratios. And when we talk about ratios, ratio are basically, for the purpose of understanding, divided into five main categories. We have liquidity ratios, leverage or gearing ratio, activity ratio, profitability ratio, investment, or what we refer to as equity ratio. So for a start, what are liquidity ratio? So let's look at the benefits first, the uses, what they're used for. Then we'll go and classify them deeper, one after another. So in the liquidity ratio, this measures the firm's ability to meet its short-term maturity obligation, not maturity, but maturing obligations as and when they fall due. This talks of short-term elements, short-term liabilities, and the short-term liabilities are expected to be offset against the short-term assets. So this is basically comparing or doing a comparison between the current assets against the current liabilities. So we also have leverage or gearing ratio. And leverage or gearing ratio, this measure the extent to which a company uses its assets which have been financed by non-owners. Basically, these are external persons. These are not the shareholders, but they are the financiers, such as debt holders, such as loan holders, loan notes holders, amongst others. So leverage ratio shows us to which extent is the company financed by non-owners. So what do you mean by this? We also have activity ratios, which measure the efficiency of a firm to generate revenue using its assets. So these ones are to generate revenue. Eventually, sometimes they are called turnover ratio because they indicate the rate at which assets could be converted into sales. Then, ladies and gentlemen, we also have profitability ratios. These are aimed at ascertaining the capacity, the effectiveness of organization under which they generate returns on the sales and investment. It measures the profitability in terms of growth of the firm. And then we have investment or equity ratios. So basically, this now look at the perspective of the shareholders. Look at the perspective of the shareholders. And in this case, we talk about growth of the shares, growth of earnings for the shares, dividends that are supposed to be paid, retention, amongst others, return on capital employed, amongst others. So there are also some limitations that are associated with this particular ratio. One of the limitations being subjectivity, meaning that they are subjective to accounting information, meaning they depend on the accounting information. They depend on the accounting information. So if there is any error in accounting information, then that will affect entirely the financial ratios. Another challenge is irrelevance. This means that the ratios are based on historical figures, figures of a past event, and they are used to make a future event. So you may find that they may not be such relevant for making a future decision. Then there is also a qualitative aspects, which is also ignored. Qualitative aspect is also ignored, meaning that mostly the financial ratios look at the quantitative element in terms of figures. They ignore the other qualitative aspects, such as motivations of employees, such as satisfaction of the customers, amongst others. In addition to them, ratios are also ambiguous. There's an element of ambiguity, meaning that different people use the different stances to describe financial information, basically to mean that these informations are viewed by different people at different perspective. Also usefulness, where ratios are computed at a specific point in time, so they might not be used free for frequent decisions. They might not be used for frequent decision. Clearly or mostly ratios are used for 1 year, or rather at the end of the year. So if there are some short-term decisions, they might not be suitable for absolutely short-term decisions. So we go to the categories of the ratios, and looking at my screen, the first ratio is profitability ratio, and we say these ones measure the overall performance and effectiveness of the firm, which is basically the ability of them to generate sales and returns. And this include return on capital employed. So return on capital employed, this shows the amount of earnings that can be derived out of the capital that is employed by the owners of the business and also the non-owners of the business. So capital employed comprises of the total assets, net of current liabilities, or what we call the financed by element. Because clearly, just a reminder, an entity has to be financed by the equity component or the non-current liabilities, mostly the debentures, mortgages, loans, amongst other long-term debts. Then we also have net profit margin or net profit ratio. So this looks at the net profit, which is the profit after tax, against the sales. Net profit margin. So margin is based on the sales. When you talk of gross profit margin, it's gross profit based on the sales. But when you talk of a markup, markup is based on cost of sales. Mark that. Markup is based on cost of sales. So a markup clearly compares, or it's a comparative of the gross profit and the cost of sales. Then we also have operating profit margin, which checks the profit before interest and tax against sales. The moment you hear margin, margin is out of sales. And the operating profit is usually profit which is not adjusted for interest, which are the finance cost and the taxes for that particular period. We also have return on equity, which is basically given by the net income, which is the profit after tax, out of the equity. That means this is a comparative or a comparison of equity resources. That's the first type. Then we go to the second type, which is the liquidity ratio, supposed to be the second one, liquidity ratio. So what are liquidity? This measures the firm's ability to meet short-term obligations when they fall due. When I talk of short-term, that means they talk of current liabilities which are supposed to be offset against the current assets. So in this case, one thing you need to know is the liquidity of these current assets. When you compare, mostly we have three types, three common types of current assets, where we have the inventory, which is basically stock, where we have the receivables, which are the debtors balances, where we have cash and cash equivalent. So amongst the three, inventory is less liquid. Liquidity, remember, when you say an item is liquid, the ability to convert into cash is high. So inventory is less liquid, followed by receivables, followed by cash and cash equivalent. So when you talk of the current ratio, this compares all current assets against all current liabilities. And the ideal or the most preferred ratio is usually a ratio of 2:1. In Arabic, they call it itnin is to wahid. That is the ratio of 2:1, means that the company has a higher capacity, has more than 100% to offset the liability. Then we have asset test, or what we call quick ratio. So in the quick ratio, they usually ignore the least liquid item. Therefore, in this case, inventory being the least liquid is eliminated, where it's given by, you can see, current assets less inventory against the current liability. So the inventory, we said, is the most liquid, so quick, meaning that they want the ones which are very quick liquid, quick liquid elements. Then we have the cash ratio. When you talk of the cash ratio, this basically means that we only deal with the ones which are automatically in cash or cash nature. So this will be given by the cash and cash equivalent against the current liabilities. This takes us to the third type of ratio, which we call gearing or leverage. And when you talk of gearing, this is to boost a business. This is to leverage a business. It talks of the capital structure of a business. So this looks at to what extent is a business financed by outsiders. And the higher the financing from outsiders, the higher the risk that an entity has. In this case, the ratios that are common are capital or debt to equity ratio, which is given essentially by comparison of all the long-term debts, basically the non-current liabilities, against the total shareholders' equity. When you talk of shareholders' equity, this is all the interest of the ordinary shareholder, things like retained earnings, things like general reserve, revaluation reserve, ordinary share capital, amongst others. Those are the interests of equity shareholders. We also have another ratio we call times interest. So what other people call it interest cover. So this shows how many times can our profit pay off the interest. And the more the times, the better the position. And it's given by the profit before the interest itself in tax against or divided by the interest charge. And I said the more the times, the better the positions. Remember, these are concept of analyzing a business. Then we have financial leverage. Financial leverage, this compares the total assets against the average total equity. Then we have the debt ratio, which compares the total liabilities against the total assets. Then we have the equity ratio, which compares the capital employed against the equity capital of an entity. So those are what we call the leverage or the gearing ratio. Then we have activity ratio, which are ratios number 4. This was number 3, ladies and gentlemen. So you will allow me to call this number 4. In Arabic, they call it Nimra Harba, number 4. So activity ratio or turnover ratio. So this measures the efficiency of the firm after employing the available resources. In simple case, they measure the ability of a firm to convert its assets into sales. Think of inventory. Inventory are assets. How do we convert? Which ability do we have to convert the inventory into sales? And also receivables are also assets, amongst others. So in this case, we'll have inventory turnover, which looks at the number of times that inventory are converted into sales and the frequency of selling stock. So it basically talks of the frequency of selling the stocks. Therefore, you can bear with me witness that the more the number of times, the better the position or the efficient an organization is. Then we have inventory conversion period. These are the number of days that the firm will take to convert its stock to sales, the number of days. And we usually want the days to be lesser. So the lesser the days, the better the entity. We have debtors turnover. And when you talk of debtors turnover, this is basically the number of times that the debtors are converted into cash. How frequent do we receive payment from debtors? And the higher the frequency, the better. That means we receive it a lot of time. So it's given by credit sales over the average debtors. When you hear average, you basically compare the opening days plus the closing days. Opening plus closing divided by 2. That's how we get the average days. Then the data's turnover in days is given by, this is the period that the firm takes to collect. So the shorter the days, the better the position. Then we go to creditors, where we have creditors turnover, which are the number of times that we pay. That is the frequency of paying the creditors. How do we pay the creditors? And the shorter the number of times, also the better the position. Then we have creditors turnovers, which is the turnover days, which are the number of days that a firm eventually takes to convert creditors into, or rather to settle the creditors. And when we are settling the creditor, like every other human being, we usually want our days to be a little bit more, because so that we take advantage of the value for money. So the more the days that we offset the creditors, the better the position. That means the credit period is a little bit bigger. The credit period is a little bit flexible and favorable to us. And then we also have non-current assets turnover, where this indicates how efficient the firm uses its assets to maximize its sales. Basically, it uses its non-current assets, which is given by the turnover, which are the sales divided by non-current assets. Then we have total assets turnover, which is given by sales divided by the total assets. The moment you hear this is the how efficient a firm uses its total assets to convert them into sales. And we also have current assets to sales ratio, which is given by sales over the current assets. And then the last but not least is the investment or equity ratio. Like I earlier said, this measures the growth of shareholders. This looks at the owners or the shareholders, and they help equity shareholders and other investors to assess the value and quality of their investment. So this basically looks at the worth of the shares in terms of earnings per share. So earnings per share basically means the earnings or the profit that can be generated by each ordinary share. The profit, the amount of net profit that is attributable to each ordinary share. That is the assumption that each share, the profit that each share was capable of generating. This is given by the earnings attributable to shareholders. When I talk of earnings attributable to shareholders, definitely I offset against, or I net the dividends to preference, because preference shareholders are not equity shareholders, divided by the number of ordinary shareholders. Then we also have dividend per share, which is the dividend payable to each particular ordinary share, which is given by the total dividends divided by the number of ordinary shares. Then we also have dividend cover, which is the number of times that the profits can pay dividends. And the more the times, the better we are. So it's given by the earnings per share divided by the dividends per ordinary share, which is the dividend per share. We also have dividend yield, which is the return a shareholder is currently expecting on the shares of a company. Dividend yield, how much they're expecting the dividend to yield. Excuse me, which is given by dividend on the share for the year, which is the dividend per share over the market price of that particular share. Then the last but not least is what you call dividend payout ratio, which is the ratio of the profit that is to be paid out as dividend. And this is usually given by the earnings that are got minus the percentage of reserve that is to be retained, or essentially 1 minus retention. That gives us the amount of dividends that is to be paid. So ladies and gentlemen, that was a short talk that we had. Click and subscribe for more videos so that we keep sharing. The next time I'll come and we tackle a question on the ratio. I hope you enjoy. I expect and I welcome all the comments. Bye.